Really bothers me. Anyway, access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. And shame on you, by the way, if you don't read this. I mean, as far as just to learn about options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. Really got to get the computer to do that. Oh, and you should change your monitor resolution. Aha! That is probably a good point because I have it set at my normal resolution. What does it look like to you guys? Really tiny? All right, wait, let me get rid of all the non-webinar windows. Go. So for you guys, it looks really tiny or something to you guys, or what? What does it look like? See, I'm a 3440 by 1440. Tiny text, okay. And when I do the webinar, do I remember what I do it at? Oh, shit. Yeah, it's my cool wide screen. I love this thing. It's one screen. It's gigantically wide, like 34 inches or something like that. And it's a really nice, it's a, what is this, a Bang? No, it's not a Bang Olufsen. It's a, I don't know what brand this is. It's either a Dell or an HP. I think it's a Dell. Envy. It's an Envy. That's what it is. Anyway, so what do we, 1920, I don't remember what I set it at when I did the thing. Was it 1289.60? It seems like small. No, that seems like two. What do you think? 1900, 1200. Okay, thank you. Oh no, now I can't do it though. Wow. Yeah, that's too small. I mean, too big. Let's try it again. 1920 by 12. How's that? Actually, not much different. All right, I think that's good though. Keep the changes. Yes, all happy? Make that big now. Push that over here. Oh, and now they show up my left. Great. Okay. All right. Are we happy now? All right, good. All right. Thanks. I just got my lunch and I am starving, so excuse me if I'm eating while I'm talking to you guys. Oh, freaking delicious. All right, anyway. It's poke, you know, like a tuna thing. Really good. You know, raw tuna with rice and some other stuff. Love it. Anywho, so let's talk about the markets. How about? Put that screen away. Let's see how things are looking. taking a little bit of a dive. Now, just a little while ago, I had said in our chat room, what did I say? What did I say? What did I say? When did I say that? Oh, this is not today. I'm like, that doesn't, none of that stuff seemed right. Okay, so page down. Okay. So at 12 o'clock, about an hour ago, I noted that we were getting rejected at 2870 on the S&P, which is, well, you can see it right there. Now that's the futures. The futures aren't the same as where the actual S&P was. So the actual S&P got right up to here, 2068.09. So at 12 o'clock, I noted we were getting rejected. And I said, now's a good time to short. And so I pointed out that the levels where we could short were, oh shit. Oh no. Oh, wait. There we go. So, this is how we meet the notes in chat. I said getting rejected at 2870 is worth a toss on the short side. And also we had a 1725 on the Russell, 25,850 on the Dow, and 7,450. Now, earlier this morning, we talked about doing the same thing we did yesterday with maybe a slight adjustment, but let's look at what we said yesterday. Because, these aren't inconsistent things, and you guys don't have to wait for me to tell you what to do. This is how you play the market, and when you learn that, don't wait for me to say when I'm shorting something or whatever. So yesterday I said, that's BJO, which is doing okay. Considering this trade on coffee, it's really awful so far though. Damn it! I know I said it somewhere. So, and again, so yesterday I talked about what we did the day before on Monday. We have lines on the futures. They're the same lines. They don't change. And if they do change, you can see where you should readjust yourself. But basically, 25.8 on the Dow, 28,860 on the S&P, 7,400 on the NASDAQ, 1,700. And it's the same drill. Wait for at least two to cross below the line, then short the laggard. And if any cross back over, get out of the trade. It's not working. Your premise isn't they're going to all go down. If they don't all go down, then your premise is blown and you shouldn't be in the trade anymore. And we thought the dollar should bounce and so on and so forth. So that's yesterday. So yes, here we go. So the dollar. Now I said that yesterday morning. If you look at a 5-minute chart, I said the dollar should bounce at, well, this is 2 days. That's the problem. So I thought the dollar would bounce at 95.30, and that was Tuesday morning. And what actually happened, can't really tell here because too much of that. What actually happened is it did bounce at 95.30. Here's Tuesday morning, and here's 95.30ish, and we bounced up a little bit. Once the dollar stops bouncing, get out of the trade, because here's the dollar coming back down, and watch what happens to like the S&P. So it's right about, 1, 2, 3, 4, 5 candles in. So that should be consistent from thing to thing. So you see, as the dollar starts, so 5 candles, well, no, it's not the same scale. Anyway, so when the dollar starts going down, the S&P starts going up. Then you get, then we got a big dip towards the end, but that was based on news. It wasn't based on just what the dollar did. But that's what you got to do. You got to watch the dollar. You got to watch the indexes. You got to pick your line. So today we had a little bit of a higher line. Instead of 2860, we've got up to here. So we decided to start shorting it again. And let's see how I'm doing on my trade. I always do this. I have a good trade and I talk and I forget about it. Oh, see, so now we're down to, this thing made $275 on 2 contracts from shorting it just about 25.8. So when it crossed under 25.8, I took 2 contracts short, and then we can see what happens. Now, my bigger premise is that the Fed at 2 o'clock is going to say something that's going to be stronger for the dollar. The dollar will come off the floor at 95. And where's the dollar now? Let's see. So it's already coming off the floor at 95. That's not very high. It's 95. Oh, it's not even 95.1 yet. So the dollar comes off the floor at 95, and that's going to put more pressure on the indexes and send them lower. But if I make $500 before the Fed without, and I don't have to, why would I risk it? It doesn't make any sense. I had a good premise. I was happy to stick with that into the Fed. But if I'm going to make that money before the Fed, or if it looks like we're turning back around here, which it does because everybody's turning green now, I just take this off the table and we'll trade something else later. So let's just kill that, and I'll show you when we get another setup, we'll take that one. But there are lots in the game at $270. And all I did was wait for it to cross below the line I wanted to short at, and then I take a little teeny ride here, and I make $270 in what was it, an hour? That's not bad. It's better than minimum wage. That's all you need to do. I mean, you just do that over and over and over again. Every time you get a good cross, and you don't know, and the real key though is not to play when you don't get a good cross. Only play when you have a good cross. When you have good lines to support. So we said short here, and short here, and short here, and short here. So I don't remember what I said on the NASDAQ actually, but I imagine I said that because that's where it was. I mean the comment. 74.50 on the NASDAQ. Yeah, so I think I mixed those up. No, that was right. Okay, so we didn't quite get to 74.50. But the point was, as long as we were below those lines, it was a good time to short whoever was lagging. So now the Dow made a big move down, a good move down. Nobody else has done anything specifically drastic. You're going to have some support here at this line on the NASDAQ, on the 20 line. And obviously support on the 1720 line. So since they both have support, it's a good time to take that Dow off the table. Not because of the Dow, because 2 other indexes have support, and they'll probably bounce off that. And now why is that? Because there's no actual news right now. We're just drifting into the Fed. So there's nothing specifically moving them that overrides what are the lines that are on the chart. That's when you technically trade. And intraday trading is very technical. Because it's not that I like technicals, it's just the technicals tend to drive the trading this time of the day. So that becomes my fundamental reason for doing the trade. Okay, so now I'm clean, and we'll wait and see what happens next. And now we'll see if there's any questions. Saudi's announced they're delaying the IPO of Aramco. How was that an announcement? I mean, that was obvious. They made a huge effort to jack up the price of oil. Didn't work. We made a lot of money shorting it. And the thing is, it costs them a lot of money to jack up oil like that. That's how we make the money, because they're putting money in that we take out. So that's going to be interesting. So oil's right about 68, 75 here on Brent. That's a more important line, obviously. We usually get to like 68.50 before we fall. Gasoline has been really strong. Natural gas is trailing off, interestingly. It hit almost 3 and now it's falling back. Gold is up pretty good. That's going to fall down if the dollar is strong, but I don't want to bet against gold because I'm kind of bullish on gold in general. Silver's all over the place, but generally it's been great since we picked it. Copper flattish. Coffee is not making much progress so far, but thank God we recovered from that. That was awful. Yesterday we hit 96.95 yesterday. That was terrible. And now it's back to 100. So hopefully it consolidates here and moves up from this spot. Let's see what else is going on. We just did a whole bunch of news, so let's take a look at that. All right. So recently, let's talk about that. Let's talk about fundamentals on the grand scheme of things. So, you know, when we're looking at trading, like I'll say, oh, I'm bullish about this, or I think this is going to hold, it's because I have a general feeling about the market going one way or the other. So I take all these things into account, like here. All this is new information. China's state TV, the official TV of China, mocks Donald Trump in a video. First of all, you know Trump doesn't like being mocked. Second of all, you know he's heading into trade negotiations with China. It's not likely he's going to be in a mood to resolve anything if they're making fun of him, and especially if he thinks that he's looking weak or something like that. Also, he needs a distraction. So trade war with China is probably his best bet to keep people's minds off the scandals. Mercedes has, I mean, some things I thought they were interesting. I'm reading a lot of stuff, obviously. So sometimes something's just interesting. It's not necessarily market moving. So, you know, Mercedes has digital LED headlights, like it flashes on the screen, which is really cool. I mean, these I'm sorry, these are on the road. These actually put messages on the road for you. Your lights put messages on the road. Laura, you know, it's crazy cool stuff we do these days. That was a good article. James Bond can, you know, the concept of James Bond, the misogynistic, sexist, sleeps with younger girls kind of spy is not right for the current environment politically. It'll be interesting if people just ignore that. I mean, to me, I'm like, it's a movie. It's like, I don't, but you know, the way things are these days, who knows? I'm putting up a lot of articles about Trump because, frankly, it's the most important thing in the world right now. The survival of the president of the United States is really important. And if you think there's too many articles about Trump, I'm sorry, it's the most important thing going on. So I want to read everything I can about it. And believe me, I'm reading 10 times more than what I put up here. I'm just putting up the ones where I feel that the author had something interesting to say. You know, where it's some information that like it conveys it. You know, it's obviously going over the same stuff a lot, but sometimes people will add some color that's really worth it. This is huge. Wayfair, this affects all retailers. Wayfair lost, and Wayfair is a massive, massive furniture company, online furniture. They lost a big decision in court, on the Supreme Court, that they have to collect sales tax for the states, and that's going to affect all online retailers. They have to collect the state level sales tax when they're selling things to people. That's a huge change. And it's going to be implemented everywhere. It's going to change the dynamics. It's going to put it takes away the huge advantage the internet had over brick and mortar retailers, which was people don't pay taxes, and you're supposed to pay taxes. I mean, I don't. Everybody raise your hands if you pay your taxes on what you buy online. You are supposed to tell the state on your state tax form that, like, say, hey, I bought $14,000 worth of things online last year, and that means I owe you 7% of $14,000. Whatever that is. So here's a check. That's how it's supposed to work now. Obviously, it doesn't work. Nobody does it. It's ridiculous. And then having to chase after all those people is ridiculous. That's not the way the law works. That's not the way it works on the retail side. The way it works on the retail side is the retailer has to collect the state tax and remit it to the state. That's the system. So that's going to be the system for online too. And that's going to change the dynamics a lot. It's going to, I mean, frankly, I don't see how it's going to be at all good for Amazon. You know, that tax advantage was a huge part of why people buy things online. So now you're adding in the taxes, suddenly things aren't going to seem so cheap. That was a good article. Concept of nothing. I like that. I'm big on philosophy and science, so that's kind of a combination of two. Big hurricane heading for Hawaii. That's not good. They've had enough problems. This is important for anybody who's got money. The Manafort conviction tax tips. If you have money and you do overseas stuff, read that. This is hugely important. Seems like nothing, but it's like foreigners cool on U.S. Treasury as supply heats up. I've been saying this for ages. We are taking on a record amount of debt. We're over $1 trillion in debt this year. That means we have to sell $1 trillion worth of treasuries. Meanwhile, when the dollar is strong, the foreign money needed to buy treasuries goes up. So the treasuries to a foreigner are getting much more expensive. They're still not paying enough interest to make them happy. And we're selling more of them, and the Fed is buying less of them as they scale back their QE program. So big problems. Big problems are going to come. And so what's the solution? There's only two solutions. Either the Fed, who Trump's unhappy with, starts buying more treasuries to make up for the lack of demand from other people, or the treasuries have to offer more interest to get people to buy them. That's how treasury rates rise, because the treasuries have to say, well, you don't want to buy them at this price, so how about this price, until they find enough buyers to sell them all. That's how the treasury auctions work. That, even without the Fed, even if the Fed doesn't do anything to raise rates, that can cause rates to rise without the Fed's interference. That's naturally how rates rise, because you're trying to borrow a ton of money. Like in Greece, the Greek Fed, or the Greek Central Bank, or whatever they're called, they didn't go out there and say, oh, let's raise rates to 26%. No, that's what the borrowers demanded if Greece wanted to sell debt, and Greece had to sell debt in order to keep the lights on, just like we do. Every month, we have to sell another $100 billion worth of debt just to keep things functioning. And it's a disaster waiting to happen. So, these are the things that keep me like on the short side when I'm making my bets. Like I don't see anything that's going to pop the market suddenly up 20%, not in a short amount of time before I can react. But I see a lot of things that can knock us down 10 or 20% really fast. China's rising regions challenge New York and Texas for economics, the Mexican peso. All right. Priced into our current rally is the fact that people think NAFTA deal is near. People think a China deal is near. I don't think so. I think the China deal is going to fall apart. NAFTA probably we can do that, but this China deal is very likely not to do anything this week, and that's going to be a disaster, because on Thursday, which I believe is tomorrow, the sanctions between us and China said the next level of sanctions between us and China go into effect on tariffs, and boom. Oh, remember I was trying to get people, my little resistance group was trying to push the concept to people that tariffs are taxes. Now we got Trump saying it. Now Trump says taxes when he's talking about tariffs. Because they're taxes. He's taxing people. He's taxing Americans for buying stuff. It was driving me nuts that they kept calling, and that everybody's calling tariffs and like pretending it's not like a tax on the American people. So that's going to hit us really hard. Another reason you want to be covered. Oh, here you go. So the Trump people are finally starting to realize it's going to hit them, these taxes. SunPower, we're interested. We have SunPower. We like them. The oil government. It's a funny one. The oil companies are they're asking the Army Corps of Engineers and the government to build massive seawalls to protect their refineries and their platforms because global warming is causing the sea levels to rise and threatening their things like that, like this refinery that's on the coastline. And well, the government, they're saying, well, we're a vital industry and you've got to protect us. They're the ones causing it. So that's pretty funny. You know, it's tragically funny anyway. All right, Trump topples exceptionalism. Senate panel postpones. Oh, this one was pissing me off this morning. You know, we're not doing anything to like make the election secure that are coming up, which is really awful, but I'm not going to get into that now. It's just really ridiculous. Powell says he's not swayed by Trump's criticism. That matters to the meeting where they're having at 2 o'clock. Trump is, you know, again, he's just trying to stir up some crap to distract people. And ESPN is not defending the national anthem. I mean, like, is that in their charter? Is that like their responsibility? Trump plans to prop up coal that could lead to more deaths and cost billions. We know that. Trump's tax cuts, obviously, we knew this when they came in, that it goes to rich people, not the working people. Tariff threats may contribute to high, that's not even news. I don't want to put that one up. I guess just because I had the current figures. Oh, here, see, that's it. Trump promises a 25% tax, not tariff, he's calling it a tax now, on every car from the EU. And I don't know. And then you got the market at record highs. It makes no sense. Why? I like this. I wanted to use cauliflower to substitute for rice and sushi. And I looked into that. It's a definitely good thing. So what she's doing with Kraft is a great thing. Cauliflower, if you cook it right and you treat it right, is very grainy. And so it's like a rice. So if you think of it with in a pizza crust, they can make it kind of like a rice cake pizza crust kind of thing. But then super, then way healthier, you know, to have. It just becomes like cauliflower and cheese on top. So it's a great idea, and I'm really glad that they're doing that. My thing would have been ingenious, so I like my idea a lot. I want to make sushi burritos using cauliflower instead of rice in the burrito, and it would have been like half the calories of a regular burrito, a regular sushi burrito. As a restaurant idea I had. Russia strengthens its military structure due to NATO. Let's see, and this is also the bullshit. We see NATO, because Trump is trying to push NATO to spend more on the military, and Putin's like, well, if you're going to spend more, then we're going to spend more. That's how it works. If we didn't spend more, he wouldn't spend more, and he wouldn't need to spend more. Oh, Google has a thing for just giving you good news. That's great. And I can just pretend nothing's happening. Home sales have been down four months in a row. Home sales have been declining. That's not good. I don't know. That one, DNC equals FBI. Oh yeah, there's an attempt to hack the DNC voting systems or something with their database. So that's where we are. I'm going to ask anything new and new. Let's take a look at the news here, just in case anything exciting is happening now ahead of the Fed. Amazon has clothing in Brazil. Who cares? Novartis, who cares? South America, who cares? Saudi Arabia, it calls off Aramco. Financial advisors working on the proposed IPO have been disbanded. Wow, that's really calling it off. They don't even have, they're disbanding the advisory group. That's weird. Blackstone wants out of subprime auto lending. I want out of subprime auto lending too. That's going to really, now, that's going to really get hit. Exxon's planning a $1.9 billion expansion. I mean, everybody's really casual at this, but the price of cars goes up 25%. And again, it's a tax. So even if you're saving jobs, are you saving enough jobs to justify all the money you're spending to save the jobs? Because my car payment was going to be $400 a month, and because of this tariff, my car payment is now $500 a month. It's very simple. I have $100 less to spend on other stuff. So the 100 I would have spent on other things is now being double taxed. This is my after-tax $100 is now being taxed again because I bought a car, and Trump gets his $100. That does nothing for me, does nothing for the economy. The money doesn't create jobs. The money goes to the government so Trump can finance his tax cuts for billionaires. That's the only place it goes. It allows Trump to put on the books that his tax cuts aren't that damaging because look how the effect has been countermanded with all this new money coming in. The new money coming in is coming out of your pocket because you bought a car and you pay 25% tax on the car to offset Trump's tax cuts. It's a complete bullshit. Anyway, that's it, nothing. So nothing else is going on. So that's where we are. We got about 30 minutes until the Fed. So let's see what you guys have on your mind. I guess we'll look at the other things. Nobody's talking. China seems to be working on a massive tax cut to be voted in October to come this effect. Yeah, and they possibly don't get the deal. Wait. You're confusing me. China seems to be working on a massive tax cut to come into effect in January, possibly if they don't get a deal by the midterm. Oh, I guess you mean probably a tax cut to offset the damage that's going to be done by the tariffs. That's all. So they're trying to help people. They're trying to help their people. We're not. We're just helping Trump's buddies. So let's figure out what happened. Yesterday we did, hang on, get that out of the way. Is it still Tuesday? I'm confused. I thought I did a Money Talk portfolio review. Was that Monday? Maybe I did it Monday. Oh, well. Oh, it's up here. Wait. Somewhere. Money Talk. There it is. So here's a Money Talk portfolio update. And this is the one that we only trade publicly on BNN. So like when I go on the show Money Talk, that's the only time we ever make changes to the portfolio. So it's about once every quarter. And the last time I was on was like July. It was like mid-July. So we made a cut. Oh, exactly. I can see from the date here. Wait, July 19th. There you go. So we made. You can see the things we changed on July 19th. We adjusted WPM. We adjusted LB. We added GIS as a brand new trade. We adjusted GE. We adjusted ABX. Wow, we did a lot. We did a lot of stuff on July. And we adjusted QQQ. So it's practically a brand new portfolio as of July. But when I want to go over, since we have a little bit of time, because this portfolio, well, first of all, it's up, what, 86.7% for the year, because basically it did start a year ago. It started in September of, I forget the exact date, but September of last year is when this portfolio started. So it's less than a year old, 9.6. So I've only been on BNN, I'd say 4 times since then. So let's say at most there's been 5 times this portfolio has ever been adjusted. We started out with 3 positions. We added a couple, we maybe cashed in a couple, whatever, I don't even remember anymore. I know IMAX used to be in here, now it's not. So I mean, you know, so anyway, so we've cashed in some positions that were winners. We've changed a few things. We always have our hedges. It's a nice, small, balanced portfolio. We only started with $50,000. Now it's up to $93,000. And again, it's very simple. We just take, I mean, it's the same positions we take to the long-term portfolio, the same positions we take in the options opportunity portfolio. They're just good, solid positions in companies that are featuring an attractive price. And the key to the position is that we always try to sell more premium than we're buying, because if you sell more premium than you buy, all the stock has to do is flatline and you're going to make your money. Anything above that, anything better than flatline is going to be a bonus. And sometimes the stock can even go down 10%. You can still make money. And we'll talk about that in these positions. So, you know, if you're finding it difficult to keep up with the market, if you're finding it difficult to stay on top of things, if you find that your returns on your trading aren't worth the time you're putting into your trading, this is a nice passive strategy. And this nice passive strategy is making almost a double in a year. And we barely touch it. And I don't even want to say we barely touch it. We are artificially tying our hands. So even if something blindingly obvious happens that we should do, we don't do it because I'm not on the show. We're not taking advantage of a quick dip or this or that or anything like that. We're not making any quick trades. I go on the show. I look at the positions as they are that day. I say, okay, we'll change this and that, make these adjustments, and then we're going to add this and that trade. We'll take away this and that trade, and that's it. And then 3 months later, we'll look at it again. Even if something happens that we could obviously do something with, we just don't do it. But even with those constraints, we're able to make some really good money. But it's all about just making, all right, what are we doing? We're diversifying. We're hedging. Look at what we have here. We have a hedge, SQQQ, but we hedge our hedge. We sold $9,000 worth of short calls, and currently our whole long call spread is only $4,400. So this is left over from a previous position, but that's all part of the game. I mean, it's all, you know, we roll it over and do whatever. It would obviously, being up 97%, I would buy those back now. But we can't, so we just have to let them expire worthless and hope they do. So I'm not going to be on again, but I don't think I'll be on again in September. Maybe I will, I don't know. July, August, September. A little short, but on the other hand, they might want me on for the anniversary. Anyway, so we have a hedge, SQQQ. We have Alaskan Airlines. We have Barrick Gold, so we have an airline. We have a gold miner. We have a conglomerate, GE. We have food company, General Mills. So consumer products, we have consumer retail is limited brands, and we have Reed Precious Metals, which is another commodity trade. So a little bit concentrated in the commodities, but that's because that sector has been particularly cheap, so we left them. And again, we had other stuff, but this is just what we have left at the moment. So we have a lot of cash. We have $85,000. So we started with $50,000. We have $85,000 in cash right now. Now, obviously, these guys have some leverage, but nothing we can't handle. So it's really nice to have all this cash. And of course, we can shut it down right now and take $93,000 off the table and walk away with almost a double. But we don't have to, because we know, and this is the point I want to make, with every single position, we know exactly what the position is, what we expect it to do, and how much money we expect it to make or lose. And you should have this for your portfolios. You should every quarter be going over all your positions and noting whether you're on track or off track, how much you expect to make, and so on and so forth. Because first of all, it helps you say, is this position worth having? Or how is this position compared to something else I have? And it's not that hard. I do it, or I do this for 5 different portfolios. It's a bitch, but I do it. But so it takes me like a day. It probably takes me like about a day's time for each portfolio to get these things done, or probably 2 days for long-term portfolio. But still, that's what you should do once a quarter. You shouldn't have that many positions. That's our 5 portfolios have 100 positions. You should really only have about 20 positions, 40 at the most. This is a lot of work for me. But yeah, every quarter, 2 days of your time should be spent reviewing every single position you have and having a plan for exactly how much money you're going to make, how much money what's on track, what your targets are. Make sure your targets are realistic, so on and so forth. So with SQQQ, we assume we're going to lose the entire 35.50 of the hedge, which is here. We already made this money. There's nothing left to make. There's only $200 left to make on this. So it's a non-issue. Now that money is already in this total, so it's not going to affect us. It doesn't count. It's not when we cash it in. It's how much money currently in our portfolio balance is reflected by that trade. So that's already in there. All we can do here is make another $200. Here though, the net is $3,500 roughly. And we expect to lose that because we expect the market to keep going higher. It's a hedge. We expect to lose it. I said anything less than that is an upside surprise. But again, we're going to not really lose it because what's going to happen is the net of this spread was $2.20. So right now it's $2.83. When these expire, they'll be gone. And when this one gets down around $2, which is the net of what we paid for this spread, we're going to salvage that money and roll that into a longer, lower spread. Again, assuming this is not in the money, of course. We're going to roll it to a longer, lower spread, and then these naked short calls will be like these naked short calls that we'll be waiting for them to expire, and they'll be hedged by the longer position that we take. And if that's not clear, ask the question, because I know it's complicated if you try to envision it in your mind, but it's always tricky for me to get people to understand this because it's kind of like trying to explain chess, and you can explain the basics, but then you start saying, but then if he does that and you do that and then that's going to force you to do that. If you're a good chess player, you can understand that, but if you're not a good chess player, like what the frick? Because you're talking 3-4 moves ahead, and if you don't really have a firm grasp on the basics, and somebody telling you what's going to happen 3 or 4 moves down the line can get pretty damn confusing. So, I apologize if sometimes I start going off on a tangent trying to explain something. And honestly, my solution on the whole has been to refrain from having extended conversations of long-term trades and the moves ahead, because I find that there's very few people really keep up with it. So it's a matter of just saying, I just have to say, like, okay, sometimes if I lay it out, like yesterday, I laid it out in the trade, like what we were going to do, and immediately I got questions back, like, oh, what are we doing that now? What are we doing? We take the 50 cents? Like, no, don't take the 50 cents. I said, only if it goes up. You got to have a plan, but you're not going to learn how to have the long range plan until you understand your current game, just like chess. First, you have to understand how every single piece on the board moves before you can understand that your next move is going to put you in a trap. If you don't know how your pieces all move, then you won't ever know if you're going to be trapped, right? But if you know exactly how your pieces move and you know exactly how his pieces move, then you have a much better idea of, well, if I do this, then he can only do this, this, or that. And so instead of being more complicated, everything becomes less complicated. And it's the same thing with the options. It's like, I know SQQ is going to, obviously, it's going to go up or it's going to go down, right? It's going to go up, down, or flat. There's 3 things it can do. So it only has 3 moves. So I need to know what I'm going to do in all 3 of those situations. And if I'm comfortable with all 3 of those situations, then my move makes sense. So in other words, the thing I do now is going to then be responded to by SQQQ, which is going to either, it only has 3 moves, it can either go up, or it can go down, or it can stay flat. So based on the move I make now, which would be, say, buying more SQQ or whatever, then I would say then I say, well, if it goes up, it changes my balance by this much, and if it goes down, it changes it this much, And if it's flat, it changes it this much. So I know between now and the next time I'm going to make a move, what possibilities there are, and I'm prepared to act on any of them. And so, you know, and then of course, obviously, once you get to that point, then you start thinking about the next. Once you get to the point where you're good at what goes next, then all of a sudden you start looking at the next move ahead. This is how it works with chess. You learn it well enough so you know the current board. Then you know the current board. You start thinking about a move ahead. Then once you're comfortable with thinking a move ahead, you start thinking 2 moves ahead. It's a natural progression. And once you're comfortable thinking 2 moves ahead, you start thinking 3 moves ahead. And you know, chess champions are like 8, 9 moves ahead. They've already gotten there. They already know what they're going to do for the next 8 or 9 moves. They know what they're going to respond to every possible thing you can do after they do their thing. And that's why computers, by the way, can't play chess as well, or could not play chess as well as people, is because the sheer amount of computations you have to make to put 8 moves into your memory was too much for a computer in the past, and they had to get past a certain computational roadblock to get that far. Now they can do it. But this is not as hard as chess, believe me. I play chess. Chess is harder. So anyway, it's just you gotta take the time to understand your craft, and taking the time, by the way, starts with this. So ALK, it's a leftover short put, so we're not going to worry about that one. But the bottom line is the ALK leftover short put is currently minus 3075. That's a negative on my account of 3075. It's a $60 put. ALK is at 65, and I do not believe there's any danger of ALK failing 65. So I anticipate collecting 3075 by next January. Not the one coming up, the one after. So that's my trading plan. Am I on track for the trading plan? Yeah, because it's at 65, so it's on track. Now in ABX, we're down 4,000 or whatever it is. And I say we need gold to recover, but ABX is a solid producer, and while we probably have to roll out, we will probably have to, I'm talking ahead, we'll probably have to roll out short puts at 17 on ABX way up here. Is a tall order, even in 18 months. I say I don't see why we can't get back to 13. That's only right here. And that would put out 25 $10 calls, $3 in the money, right? That $10 calls would be $3 in the money at 13. And since 23 times 25 is $7,500. But that would be, and that, if I didn't change the short 17s, I have a $4 loss on 10 17s. That would be 4,000. But that still leaves 7,500 minus 4,000 is 3,500. Now, if I go from minus 42.89, right, that's the current balance, which obviously is not going to be one number. ABX, so 7,000, and that minus 7,000 plus 4,000 minus 1,000 is 42.89. So if I go from minus 42.89 to plus 3,500, then my upside potential on my total is going to be 77.89. That's fantastic. So even though it's a losing position, I can easily see where it can turn into a winning position. So there's no need for me to do anything about that one except for wait and see if it does actually rebound the way I think it will. So, you know, and that's why sometimes we do this a lot. You know, we'll have a pretty horrific loss. This is a bad position. We'll have a bad loss in the portfolio, but meanwhile, we're like, yeah, you know, so what? We'll wait. You know, because we have 18 months practically for this thing to resolve itself. And really, it's all a function of the price of gold. But again, you see, even so, we have a trading plan, and I know a lot of people tend to look at the balance sheet and just say, oh my God, ABX, why do we still have this terrible position? We have this terrible position because it's already terrible. And if it gets less terrible, we're going to make $8,000. So it already has been a terrible position. It already cost our portfolio $4,200. But if it turns around, since that $4,200 loss is already in our portfolio's total, if it turns around, it's going to be an $8,000 gain. Not just the 42, and not just that we erase the loss, but we expect to erase the loss and end up with a little bit of a profit. And you see, we see how these numbers start racking up. So I know on this position, I'm going to make that much. On this position, I'm going to make that much. How am I going to make that much? As long as they remain on track. I have a trading plan. I have an expectation that they get to 13. And based on that expectation, here's my profit expectation. And then GE, same kind of thing. General Mills, same kind of thing. I don't want to go over everyone because the Fed's going to be on soon. Every position we talk about how much money is left to gain, where we expect to be, are we on track or not, or do we make, and if we're not on track, we make an adjustment. So, what? Why is there another one right after that? What do you do? Like it's doubled. Yeah, why are you playing downside bets in portfolios? Yeah, somehow it's got double thing. All right, anyway, we'll fix it later. So the main point, though, I hope I added this all up. Yeah. So if these positions remain on track, they're going to make $50,000, which is 100% of our original $50,000 that we put out last year. So my plan between now and next January is to make another $50,000, which will put this portfolio up about 200%. So that's where we are now with the positions we currently have. We haven't added any. We have, though, $85,000 to spend on new stuff in between now and then. And again, once a quarter. Once a quarter, we're not allowed to trade this portfolio. Not allowed, that's just my policy, because it doesn't make sense to do a portfolio for a TV show and then trade when we're not on the TV show. That's ridiculous. So we don't trade other than when we're on the show. I get on the show, I say, here's the trades I want to make, then we make them, and then we see how they work out. I cannot be more passive than that. And the most important lesson of this kind of portfolio is that we don't babysit it. We don't look at it constantly. We leave it alone and let the positions run. And sometimes they go up and sometimes they go down. But on the whole, if you follow the strategy, if you be the house, which we talk about all the time, if you be the house, if you're the seller of premium and not the buyer of premium, and you follow this plan consistently, you will make great money. See if we got any questions on that. No. What topics are you expecting from the Fed today? I don't get that. I mean, it's not a topic. They have a letter. I mean, not a letter, minutes of the meeting. So the topics are just, they're going to talk about the same stuff except in more detail than they did at the press release. That's going to be on any second now. I didn't get back in the index shorts, unfortunately. Whoops. Memory issue, I think. So the Dow came down a bit lower from where we got out, but other indexes are still pretty high. So if I was going to short someone now, I'm going to short the Russell. And in fact, I'm going to take one, 17, 23, 40, just because I really think the Fed is going to disappoint. But that'll strengthen the dollar, though. The Russell doesn't really hate a strong dollar, so we'll see what happens here. But they're the one that's highest, and I think they might get dragged down on this one because the Fed's not going to say anything that's going to be too drastic. But we'll find out in about 30 seconds. So let's see. Let's find that thing now. FOMC minutes. So let's see what statement minutes, and we're just waiting for this one. So the meeting was on July 31st and August 1st. And so keep that in mind also when you read these things. You got to realize it's a time capsule and it's not necessarily what they currently believe. You have to think about what changed between then and now. Let's have a little bit of lunch while I'm waiting. Generally, these minutes are kind of like non-events, but let's see what happens. All right, 2 o'clock. Theoretically, it should refresh, but we'll see. Not yet. Oh, come on, man. What is the point of having a website if you don't release the minutes properly on your website? The news people seem to have them. Market's not moving much yet. Shoot. Hang on a second. These two fellas. Oh, they noticed that housing was slowing down. That's interesting. Oh, come on. Ooh. They think accommodative may not be an appropriate word for policy anymore. The trade war is uncertain and risky. There we go. All right. Let's see what we got here. Wow. A lot of words. So basically, they're seeing a robust economy and the overhang of a potential trade war. Not much different than where we are. Economic situation. Labor market continues to strengthen. GDP rose at a rate, 2% here. This is what they care about. They care about the labor market and they care about inflation. And so inflation is at a 2% mandate, which they've been a bit flexible on this, so they can go over 2% for a while. But the labor is becoming a problem. Unemployment at 4%. But the labor force participation rose by a similar amount, leaving the employment to population ratio unchanged from May. Okay, so they're saying that although the unemployment rate went from 3.9 to 4%, so theoretically more unemployment, though not much, the labor force participation rate rose, and that means that more people are working even though unemployment seems higher. There's just more people in the labor force, leaving a little bit more people unemployed, but on the whole, it's a good ratio. So again, that means that what they're saying though is, again, more people employed, full employment, and the Fed has to start tightening before wages get out of control. That's what they fear the most. They don't like rising wages because that's a sure path to inflation. Which is funny because, you realize the Fed's job is to keep wages from rising. So the Fed's job is to screw over the workers. That's basically their whole function. Index hourly labor. Okay, this is what they care about, the hourly labor compensation, and they don't want that to start growing out of control. And by the way, don't forget the Fed is not part of the government. The Fed is a group of banking, is a banking consortium that is put in place by the big banks, JP Morgan, Goldman Sachs, Citibank, all those people. They all have people in the Fed. Those people rise through the ranks, but they're banking people. And then Trump picks one of them to be the chairman. The president picks the Fed chairman, but he's only picking from people that the banks have already selected. So that's the only nod to the government, to the control the government he really has. Once he picks them for life, and that's that. Not for life, but it's a long-term appointment. The president can't change it. The president can't really like remove a Fed chairman if he doesn't like him. So why does the Fed want to control inflation? Because the banks lend money for 30 years and 10 years and so on and so forth, right? They get car loans. I mean, like a home loan, a business loan is 10 years, a home loan is 30 years. So they're lending you, $200,000 to buy a house, and you're going to pay them back $450,000 basically. You're going to pay them back 150% more than you borrowed over time, even at like 5%. I'll show you. In fact, listen, this is an amortization. Whoops. No. Amortization. I don't know if people actually realize this. Table. So you spend 200. You borrowed 200,000. All right. Well, okay. Purchase price of the home is $350,000. You put down $150,000. You finance $200,000 at 4%. Okay. And obviously it's going to be for 30 years and your payments are monthly. Calculate it. Now, you're going to pay $1,000 a month. And over time, though, look what you're paying. This is at 4%. Over time, you're paying your $200,000 back and $143,000 in interest. That's at 4%. At 6%, frick, went too far. Where is it? Oh. At 6%, you're paying another $100,000. $431,000 paying, that much more. That's what I was thinking, was a 6% loan is where you pay 150% back. So it makes a big difference for one thing. Now, here's the thing though, currently the banks are lending at 4%. They're only collecting over 30 years. So I want you to understand the motivation of the bank here. So let's go back to the 4% thing. God damn it. There it is. So if they're lending at 4%, I'm going to go back to that calculation. So 30 years from now, they're going to get back their money and they're going to get $143,000. So what they've gotten is 75% interest. Let's be rounding it off, divided by 30. Need a calculator. So it's not really 75, it's like 70. 144 divided by 200. 70 what? Stupid things in the way. So 72% interest. And divide that by 30. Look, 2.4%. There's the Fed's magic inflation target. They don't want inflation being so high that the bank doesn't make a profit on the money they're lending you. That's it. That's all they give a shit about. If the bank lends you money on a fixed term for 30 years and all they're going to make is 2.4% per year, then if the inflation is more than 2.4% a year, they're getting back less money than they lent you. Even though it's more money, it's effectively less money than they lent you. They need this money to stay ahead of inflation, and that's how they make their money. They also make their money because they get it back not all at the end, they get it back before it gets eaten up by inflation. So they do very well. Don't worry about the bank. They're okay. Not only that though, but they're borrowing the money from the Fed. So they're not even using their own money for this transaction. So they're not tying up their $200,000 and they're collecting this money. They're tying up like $20,000 of their own money. They collect all this money. and if it defaults, there's a loan thing, there's a default system that you pay for. So it's a great scam. But anyway, the point being though, the Fed doesn't pull this number out of their ass. This is the number they need to make sure the banks who they work for make a profit. And that's why, and so if labor costs are going to have the danger of driving inflation up to the point where they don't make money lending money, they're going to put a stop to it. And that's it. That's all they care about. They don't care about Trump. They don't care what Trump wants. They don't care about the economy and they don't care about the stock market. None of those things concern them. They care about how do we make our banks money? How do we assure the future of our banks? That's what the Fed is for. The dollar's dropping off that Fed thing? I wouldn't think so. That seems like a weird move. I forgot to put that bet on. Oh, good. Okay, $55. All right, good. What is the dollar doing? Well, now let's see. So now things are starting to fall a little bit. Who's making? Like I said, I picked that one because he was lagging, and he was going down the least so far. So I figured if everybody starts going down, he'll start following. So that's working out so far. But as you said, the dollar got weak, and that's where I caught a break on the Russell. DX. Now the dollar's bouncing back off the same line. I think it was a head fake for the dollar. But still, we'll see what now. So I'm going to keep a tight stop on the Russell, though, because if the dollar's coming back, the Russell might like that. So make a quick $70. Nope, 65. One more tick up and I'm out. Yep, that's it. All right, so $60. All right, fine. So now we'll see what happens. But at the moment, it's like I said, you get in, you get out, you make quick money. So now I got 270 for my Dow play. I got $60 from the Russell play. I'm waiting to see how everybody's starting to react to this. There's really not much reaction though at the moment, so I don't think much of it. And now we can go and see what other people are saying, or if there's any other comments and so on and so forth, and get some color to this thing. Let's put that back down. And the VIX gapped up 3 says, let's see if we can find that. Well, I don't know how accurate that is, so let's look at a closer one. No, I don't know what you're looking at. It's way down there at 12, so nobody's being volatile about this stuff. But you see that's the thing. If you make quick money and then it starts slowing down, and you see the other index is not going your way, that's a good indication to get out. And yeah, I would have liked to have made more money. $60 a month. I mean, it pays for my lunch, so I'm happy. It pays for my lunch and dinner for that matter. So I can't complain about that. But for me, my lunch not because it's lunch. But it's not take the kids out for sushi day kind of money or anything like that. But you can't only play to win big money. You got to learn to take the small money off the table. So there's nothing too damning about the Fed report, but let's see. Go back to Seeking Alpha's breaking news, see if anybody comments on that. Home. China Unicom promises 300 Beijing 5G bases this year. Wow, dudes. China Mobile said they were going to have them. Where are they? So China Unicom is trying to outdo our boys at China Mobile. See how that plays out. I'm just reading this real fast. Retail heavyweights lead the sector. That's important. Number of retail stocks are at all-time highs. Walmart, Target just knocked it out of the ballpark on things. Lowe's had great sales. Home Depot's getting dragged along with them. Retail names trading their 52-week highs are Best Buy, American Eagle, Costco, Dollar General, Five Below, TJ Maxx, and Wolverine. Strong U.S. macroeconomic backdrop. They are observing the chain stores are starting to see the benefits of the e-commerce investments at scale. E-commerce productivity has been a common theme on earnings calls. All right, so everyone wants to be like Amazon. All right, and we read up to there, so we're fine. And now the next thing we do is take a look at Twitter. And see what my guys are tweeting about. If you bought $1 million in Venezuela's local currency when Maduro came to power in 2013, it is now worth $3.40. Wow. Can you imagine? The only way this is the longest bull run market on record is if you call the 19% decline in 1990 a bear market. Well, I think you could. Okay, so they're saying there's a lot of 19% declines that weren't counted. What is all this? I've canceled my meeting with Judge Kavanaugh, who is Trump is an unindicted co-conspirator in a criminal matter and doesn't deserve the courtesy of a meeting with his nominee. Wow. Oh, wow. So it's not just her, but apparently this is a thing now with the Democrats. Kamala Harris, Cory Booker, Ed Markey. Wow. His nomination is tainted. Wow. That's an interesting tactic. Obviously, it's all the Democrats are doing it. Damn you, $15 an hour minimum wage. King County, Washington, Seattle, King County, checking in with a 10.1% year-over-year gain in average wages. I know Seattle's such a total success with a $15 minimum wage, and everybody and the conservatives still want to stick to this talking point that's destroying economies, whereas Seattle's like one of the best performing economies in America. Credit card delinquencies at nearly 5,000 smaller banks in the U.S. rose to 6.2% in the second quarter. That's nasty. Wow. This exceeds the peak during the crisis by a full percentage points, not 4%. What the hell's going on there? That is awful. Credit card delinquency rates for smaller banks. So what is it that they're doing wrong? I guess people got their credit cards canceled or whatever from big banks during the crisis, and they probably turned to like their local banks to get like smaller credit cards. It's probably misleading us. The total amount of credit is probably a lot lower than it used to be. I mean, the larger banks. Not as much credit, but it's getting, that's a bad number. And when they say the financial crisis, they mean here, when it started, we were down to 5%. Now we're at 6.2%. This is a bad sign. You don't want to see that. All right. Meanwhile, not as many people have thought of it. See, it's interesting that people are not writing about the Fed. I mean, my guys are mostly financial people. All right, here we go. Fed minutes, another hike soon. Emerging markets and trader risk, yield curve discussed. All right, that sounds like it might be worth reading. All right, read this. Participants cite statistical evidence for the U.S. that inversions of the yield curve have often preceded a recession. We have an inverted yield curve now. That suggests the policymakers should pay close attention to the slope of the yield curve. All right, so that's another thing they're going to worry about. That's crazy. Fed minutes release, blah, blah, blah. Many participants. What does he think is important? Okay, if economic conditions remain steady, it would likely soon be appropriate to remove policy accommodation. Further gradual rate hikes consistent with sustained economic expansion and solid the same crap as they always say. All right, so there's really nothing here, and so we default to, whoa, wow, look at this. So we default to the market could be selling off nicely. And I'm not going to chase anything though. The VIX is still really low, so nobody's too panicked about things. This should be the NASDAQ NQ. See, so now in this situation, if I would have stuck with those Dows, I'd be in great shape. In this situation now, I'm just watching and seeing what happens, but clearly we have a nice line here on the NASDAQ, 74.30s. It's not only an even money line, but it's also the red line here. So he's below his red line, he's below his red line, he's below his red line. So the NASDAQ's the only one that isn't below his red line. So if they fail 74.30, they become the best short because we can use 74.30 as a stopping out line. I don't have any particular reason to shorten though. It's all the Fed seems to be doing exactly what we thought the Fed would do. So to me, it's not news. You know, it's just because other people didn't know it was going to happen. If I knew it was going to happen, I don't consider it news. And I think there are people as smart as me at some major trading houses who also didn't think it was news. It's the TV people who are totally confused all the time. And then they in turn confuse all the retail investors. But that's on purpose, of course. You know, they want the retail investors to be confused. That's how they make their money. They got to get their money from someone, right? It's hard to get it from each other, but it's easy to get it from suckers. So at the moment, there's no panicky here. There's nothing really bad. The Dow had a nice little dip, but you know, we didn't catch that because I was playing with this guy. But he's right back where we stopped out. So we'll see what happens. If there's going to be a leg down, though, somebody's going to break, and then these guys are going to follow through, and they'll be easy to catch. We'll catch them right about here as they go down. Questions? Sri says, you were watching the futures page on Fed. Is it worth buying CHL long term? Yeah. I look, it's China. All right, look at this. Here's the whole thing of CHL. China Mobile. I forget the number. It's like a stunning number, so I just don't want to get it wrong. Oops, profile. No, wait, that's not that. I don't know what Yahoo does now, but it doesn't automatically go to the symbol like it used to. Okay, as of December 31st, 2017, so that's a year ago, the company served 887 million mobile customers and 113 broadband customers. All right, so this is a big number. 887 million mobile customers. That's a lot of people. The company is $189 billion. The revenues, 700, these are whatchamacallits. So it's about 100 billion divided by 7, let's say. So I think it might be divided by 6 now, but divide by 7 won per dollar, and it's 120, 100 and something billion, 100 and whatever $billion, with a very nice profit too. I mean, they're making good money. They're making almost 20 billion, so it's 16 billion, 17 billion on 110 billion revenue. So they're 15% profit margin. All right. So you compare that with AT&T, 160 billion and 30 billion in profit. Okay, so they're 50% bigger, let's say, and they're $238 billion. But the difference is AT&T has who can tell? Internet 13, they got 13.5 residential, 25 million, I guess. I'm confused. I can't even tell what the mobile phones are. Internet segment, handsets, who knows? Anyway, they got a lot less than 800 million. Let's say AT&T has 70 million subscribers. All right, 1/10 the amount of subscribers. So if you want to take a play that so they're comparably valued, but China's potential for growth is much bigger than AT&T's because China Mobile has 800 million subscribers, and they're paying obviously a much lower price per subscriber than AT&T. So you'll benefit from China's growth in that as the Chinese wages go up and so on and so forth, China Mobile gets to raise their fees and becomes much, much more profitable. So it's kind of like betting on AT&T in the earlier stages of like the 60s and 70s when they were growing at a really great clip because people were getting more services and more this and more that, and then the mobile phones came out and they exploded. That's where China Mobile is now. The thing is that they're charging like, cricket prices, cricket wireless prices for the phone service because people in China can't afford that kind of service yet, but they will. Okay, you see, and believe me, you saw that in America. That's the thing. You saw this in America in the 80s. I remember in the 80s, I convinced my boss to get mobile phones because it made us more productive. I said, I sat there and I did sheets, and I said, look, we drive around, we have to keep stopping at phones to call people. I said, you're taking away one sales call a day. If I'm making 5-6 sales calls a day, and I'm spending 45 minutes on a phone, standing at a phone booth, pumping quarters into it to talk to people. I said, if I spend that time instead of my car actually going somewhere and talking to people at the same time, I said, first of all, I'd talk to more people. I'd be more inclined to talk to people. Second of all, I'd be able to visit more people. Third of all, I'd be able to find out if something happened instead of you guys having to wait and wonder where I am. There were so many great reasons to do it. And lo and behold, of course, it made us much more productive and then led to a huge increase in sales that completely outweighed the cost of the phones to the point where everybody in the company got phones. Just because I was bullshitting about how ridiculous it was, I didn't have a phone. But it's just a fact. I mean, it takes time, but the efficiencies are there and the cost analysis is there. And companies, it becomes more and more important to companies to have it, becomes more and more important to people to have it. Because obviously now everybody's got a phone. Every child has a phone. Now, but when I did it was a special thing, and that was only 30 years ago. So just 30 years ago, it was a big deal to have a phone. And that's where China is now. It's not a big deal to have a phone, but it's like, it's not, they don't have all the luxury services we do. They don't have a phone with Wi-Fi like we do. They don't have a phone with all the computing power that we do, but they will, because obviously you wouldn't give yours up. And they see people who have them and they want them. So as they become a little bit more prosperous, it moves along, boom, boom, boom. So it's a great way to just invest in the total growth of China. And meanwhile, you're getting a very, very fairly valued phone company as it stands right now. So that's why I like China Mobile. I think it has more upside potential than AT&T, which is basically, what are you going to do? They're unless they get out of America and start servicing other countries, which really they're not able to do, there's nowhere really for them to grow other than raising fees for the people they have now. They're not going to gain a lot of market share. They're not going to be able to do much for services. They can add some things, but it's just every time they add something, everyone else adds it too. It's tough. And you can see China Mobile doing that too. The China Unicom is they're putting up 5G as fast as China Mobile is putting up 5G. So you know it's just that's the situation they're in. But China Mobile's already got their 800 million people. That's more than half the population of China uses their system. They're not going to lose them unless they don't keep up with the new services and such. But the trick is to go after that high-end service, keep getting the money, and then have it trickle down. And as that infrastructure ages a little bit, you trickle you trickle those services down to the poor people who can start affording it, and then it spreads, and then your income stream goes driving up, which is how AT&T became an explosive stock at one point. Now it's a steady stock, but it used to be explosively growth. So China Mobile's coming into that period now. AT&T's past it. I love AT&T. I like them as a steady stock. I invested in it based on the fact they're not going to go anywhere. I love that because by selling options, we can make a lot of money doing those kind of trades too. Phil, BJO, why not buy BJO and sell calls on it instead of paying over $3 for it at the money? I want to limit the losses, and I don't want to tie up a lot of cash in BJO, and it may deteriorate over time, so I can roll it. And it's going to cost me less money to roll it than to keep trying to cover. Because so several reasons for it. It's just not, you know, it's the point is to make a limited loss trade more than anything else, and not tie up a lot of money. Because we're just making that quickie upside bet trying to capture it. So how are we doing? Nothing's happening, huh? Boring. All right. Oh, they did go below 78,430 though. Nobody said that. Were they above it before? What happened? Anyway, I'm not getting it's not, you know, it's not a good signal. These guys are he's green. He's holding up here, and even though he's below his line, I'm not getting confirming signals. So we don't trade. If you're not sure, don't trade, because even when you are sure, you're going to be wrong half the time. So only trade when you're sure, because if you trade when you're not sure, you're going to get screwed a lot. What else are we talking about? Ooh, I had something I was going to show you, and I forgot. Oh, I know, because yesterday we did the options opportunity portfolio, didn't we? Home. Now, the options opportunity portfolio we started this year on January 2nd or 3rd, and it's up about 30%. Is that right? Where's the bottom? Oh, it's a part 2. There you go. So it's up about 30% for the year. This one's been more actively traded, so and is doing worse than the Money Talk portfolio. We had some unlucky hits in this portfolio. We took a few bad things. Here's the BJO spread we were just talking about. I didn't want to sell puts. It's been a terrible, terrible performing ETF. So we just want to say, look, if they can get back to 41 by March, which I think they will, then we're going to make our money, because all we're paying here is we paid about $1.05 for the spread. It's a $3 spread, so it's going to make $1.90. So, you know, he said, why don't you? I'm sorry, who said that? So Garrett said, why not buy BJO and sell calls instead of paying $3 for at the money call? I'm not paying $3 for an at the money call. We're paying $3.50 for the call, but we sold the other call for $2.45. It's a spread. So the net is $1.05. So I'm paying $39.05 to be in BJO. I need to be over $39.05, but that's all I need. I'm not paying a $3 premium. I'm selling a premium. And by the way, I couldn't go more in the money because they don't have any that are more in the money. Let's BJO. If they had a lower strike, I would have probably taken it, but they don't have any lower strikes because nobody thought it would go this low. What is that? Go away. Why is that there? Shoot. What is this thing? Trade. Oh, I can shut down the whole thing. There we go. So March, see, it only goes down to 38. So that was the lowest that we can go on this one. Now it's 340. But you can still do this trade. Look at 340. It's even better than it was. 340 and 260 or 265, and that's only net 80 cents. Wow. So it's actually. Oh wait, no, I'm sorry. It's the 41s we wanted to sell. The 41s are now yeah, it's about fair. 228. So 340, 228. So it's $1.12 now. The point is, if I could have gone lower, I would have gone lower, but there was no option to go lower. So we're just taking the strikes we can get right now. But the point is, I'm only risking $1.12. So if you wanted to make the same money, you say, how about if we bought it and sold the put? So you buy the 38s, you'd have to buy, well, how much are we going to make? We're going to make 20 times, what do we say, 290? So that's $5,800. We're going to make $5,800 with our trade. Now, how would you make $5,800? You would have to buy pretty much almost 20 of these. So you'd have to buy 2,000. And so how much are we tying up on the spread? For 20 at $1.10, we're tying up $2,200 to make $5,000, $5,800 in fact. So we're tying up $2,200 to make $5,800. I think 190. No, wait, sorry, $3,800. So we're tying up $2,200 to make $3,800. So to make $3,800, what you would have to do if you want to sell 10 of these puts for $350, 10 of these calls for $350, you would have to spend $38,000, sell these for $3,500. So you'd have $35,000 tied up instead of you'd have $35,000 tied up instead of $2,200, and you would make the same money, except that you would need $1 because you sold the 38 calls. You'd need $1 less than we do to make the same money. But that's it. I would rather have the $35,000 and have that to play on other things. So that's another reason not to do it that way, is because what am I tying that money up for? You've already got a limited upside. And again, if there was a lower strike, I absolutely would have rather been in the money. I would have rather had the 35-38 spread. Much rather have had that spread. It's not available. So what should be our play with gasoline? Are we trying to capture the short post level? Blah, blah, blah. Okay. Yeah, let's talk about that. Gasoline. Shorts. All right. So you got rejected right at 75. Hang on a second. You know, the problem is I ordered this delicious sushi lunch. I'm so hungry, so I haven't eaten all day. So I keep putting it down, but it's just sitting there. All right. See, now things are getting a little uglier. All right. So we got rejected right at 68, right at 75 here. I don't care about that. Our premise was that gasoline would go higher into the holidays, but that's when gasoline was at $2 before. Now it's $2.06. That is higher into the holidays. It'll probably keep going up. Next week's, the holidays not now, it's next week. Next week, we got to take this very seriously. Hopefully, it'll run up even higher next week, and we can short it, because after the holiday, it's going to be all disappointing. The demand numbers aren't going to be what they think it is, and then they're going to have no catalyst again until what? Thanksgiving is the next real holiday where anybody's going to be driving, and it's not. It's a good flying holiday. Everybody flies or drives or does something, but people, a lot of people have a Thanksgiving home. It doesn't have the kind of impact that like the last weekend of summer has, where everybody goes somewhere, right? Because don't you feel like a total tool if you don't go somewhere, like on Labor Day? I mean, some people do barbecues and stuff, but mostly people like to go somewhere and do something. You know, you want to get out there. But I'm probably going somewhere. I'm probably going somewhere next week too. So let me see. So it's a good solid driving holiday, but again, and the thing that people are not catching on to in the press and the media and so on and so forth, it's that the more cars they sell that are fuel efficient, well, somebody has scored on to this. Trump's administration has scored on to this because they want to take away all the mileage requirements for cars, because the higher mileage requirement cars, which are now required, the average fleet that their manufacturer sells has to average 35 miles a gallon. That is 75% better mileage than the cars that are being turned in. So like the current fleet averages about 20 miles a gallon of used cars, and you're turning them in for cars that have 35 miles an hour average. So new cars use 75% less fuel than the cars they're being traded in for. Therefore, there's a constant driving down of fuel usage by new cars. And that's never going to stop unless the administration takes away the mileage requirements, because on Obama's schedule, in I think it's like 2028 or something like that, it's supposed to be 50 miles a gallon average for a car. And by the way, the Trump people saying, oh, it can't be done. And that's what they said when they made it from 20 to 35. When Obama first passed this rule, they said it couldn't be done. It got done. It's doable. Europe's doing it now. That's the even stupider thing is the same car manufacturers are selling their cars in Europe where there is a 50 mile per gallon requirement. So it's not that it can't be done. It's that America is the only country not doing it. But you know, obviously, these guys have no problem lying to your face, so that's what they're doing. That's just, you know, this is all about trying to create or keep up a demand for fuel that doesn't really exist or shouldn't have to exist, because it's not about stopping people from driving. It's about having them drive more fuel efficient cars. And when you mandate that cars have a certain level of fuel efficiency, then you're not taking away people's choices, because those are the cars that are available. You know, it's funny because they say, oh, that's government interference and whatever. But meanwhile, it's like, okay, I only have the choices of stoves that don't explode. I can't go to the store and say, give me a very unsafe stove that blows up and takes my house and my neighbor's houses with it. It's like, no, you're not allowed to buy those. Give me a refrigerator that locks children in it and kills people. No, you can't have that either, okay? You can't have the toaster that electrocutes you. They could make them, but they aren't allowed. Yet a car, suddenly everybody's like, oh, freedom, you know? It's like, it's bullshit. You can make requirements of products. You can say these are the minimum standards that we're willing to accept as a country. That's why you elect people to vote. Yet these guys get paid off by the oil companies to stop that from happening. It's really insane. So anyway, but the bottom line is, at the moment, even with Trump's efforts, you can't stop what's happening, which is every time somebody buys a new car, they are effectively buying a car with better mileage than the car they have. Therefore, every day, every person who buys a car will buy less gasoline next week than they bought last week. Every time somebody buys a new car, they will buy, for the next year, they will spend less money on gasoline. I'm assuming gasoline prices don't go way up. And that's less demand. That causes a glut. And that's why every single holiday they're disappointed with the numbers. They're going to be disappointed. And the more people drive, the more miles people drive with their better efficiency cars, the more disappointing the demand numbers are going to be. Not less disappointing, more disappointing. Because their assumption, and that's where the discrepancy is. Because before the holiday, AAA does a survey and says, oh, this many people are planning on driving, their average trip plan is this much, and it's a perfectly valid survey. And they'll say, oh, because the economy is doing better, you have, let's say you have 70 million Americans this year as opposed to 65 million Americans last year are planning on taking a trip with their families, and the average trip plan, the average trip is going to be this much. It's going to be the same 50 miles or whatever, 100 miles. So that means we're projecting this many more miles are going to be driven. 5 million times 100 more miles is what, 500 million miles, and you divide that. But that's the problem. You're taking the 5 million miles and you're assuming that it's going to be at last year's pace, because that's what they do. They run the price of oil up and they say, well, if there's obviously going to be that much more demand, so if there's that much more demand, therefore they're going to use this much more oil. But what they don't understand is that of those 65 million people, 5 million people bought cars that get better mileage in the last year. And those people are going to drive and consume far, far less oil than they did. And every year you have more and more of the high economy cars on the road and less of the gas guzzlers. And that's why all their numbers are wrong and all their predictions are wrong, and they're disappointed every single time, yet they do it over and over and over again. But of course they don't want to fix it, because if they fixed it, they would be predicting lower demand, and that would be a disaster, and then the whole thing would collapse. So they'd rather fake it into every holiday and start the same dance, the same song and dance that drives the price up the same way every time. And we had this last holiday, right? The July 4th, we did the same thing. It was busting up on July 4th. I'm like, just short it. And I'm saying the same thing right now. We're just going to short it. I don't know exactly where it's going to settle, but hopefully exactly into next weekend, there should be, in theory, this week they had a drawing in oil because the refineries are making a lot of oil. They put it out there, and so there was a build in gasoline and build in distillates for the aircraft fuel, gasoline for the cars. So there's a build in gasoline, build in distillates, because the refineries are getting ready to ship it to all the gas stations. And so it hasn't shipped yet. They just started to build it. They're sucking up more oil, making more gasoline and more distillates. Then they're going to ship it to all the gas stations. So next week, when the gas stations say, oh, I better top off my tank before the holiday, right? My big fuel tank thing. So they say we got to top off our tanks before the holiday. They're going to order trucks and trucks and trucks of gasoline. There's going to be a draw on gasoline next week because all the gas stations are going to top off. And then the holiday demand comes in. And if that holiday demand is disappointing, what happens is next week, all the guys who topped off their gas stations are going to say to the refiners, oh, no, we don't need any gas this week. We have plenty from last week. And that's when it crashes. And that's exactly what happened on July 4th. That's exactly what's going to happen this time. So the trick is, what exact day is the holiday? In this case, though, it happens to work out really well because it's a week from Monday is the actual holiday, which means that really this is playing out almost perfectly for us, that we should peak out next week when they're going to show a draw. Next week, there's going to be a draw on oil because no gas station in their right mind is not going to have full tanks ready to sell over the holiday weekend. So everybody's going to be ordering gasoline next week. There's going to be a nice drawdown in gasoline. Hopefully, it'll hit 210 or 212 or something like that. It was like 225 in July. And then we can short the crap out of it, because after the holidays, there's no reason this thing should be that high. Let's see. Yeah, we almost hit 230 in July. Well, I was in June. Sorry, in July it was 218 actually. So we were really high in May. Oh, that was the May holiday. That's right. I'm sorry, I forgot that one. That was Memorial Day. Yeah, it's Memorial Day. So Memorial Day, we had this fantastic, perfect spike up into the holiday. Then after the holiday, collapse. And then into July 4th, it runs up. After the holiday, collapse. And then whatever. And now we're going to have a nice run up into the holiday. And then after the holiday, it's not that hard. It happens over and over again. It's not that hard to trade. There's a look, here it is again. Look at that. Whee! And then collapse. The only question is whether or not you're going to bet on it or not. You know it's going to happen. And that's why we went long last week, because at $2, I was like, damn, let's start getting in on this, because, you know, that was a good place to get in. We took quick money and ran, but that's because overall, I think the thing's going to, I don't know when it's going to collapse again, but it will. I'd rather be short than long. I don't like being long when my longer term premise is short. Oh, am I missing the thing? Oh, well. What can I do? There goes NQ, Albert says. On gasoline, do you play RB? No, we're playing V8, I think. Yeah, we're playing V8. That's next month. Not the current month, the next month. So what happened with these? Not that much. Not that exciting. No, look, we're drifting. The Dow's down to 80 points. It's just why should we be higher? Hang on. All right. About 10 minutes, I'm going to put out a bullish premise. Was it yesterday or today? I feel like it was yesterday. Sorry, we're not going to do the options opportunity because I went off on a tangent. Let me look for this. There was a chart, and I really liked it too. Oh, there it is. Yay. That was easy. Let's see how big we can make this. Oh, nice. All right. So far, as of August 21st, blended growth scorecard, remaining report. Okay, reported remaining. 218 Q2 earnings revenue. Okay, forget revenue. Well, revenue is important, but basically, 75% of the people have reported, and 75% of the people have beat expectations on earnings. Part of it is because of the taxes. Lower taxes is helping with the earnings. Here's who's beating on revenue. Revenue is more important, right? Got about still solid, like 65% are beating on revenues. So that's good. I mean, that's nice revenue growth. Who's lagging? Catalog and retail, internet catalog and retail are actually kind of lagging. Half of them are below. Leisure products lagging, household products lagging, hotels and restaurants lagging. It's interesting, right? But there are less of them. There are lots and lots of textile apparel. 93% of the textile, apparel, and luxury goods, 93% are beating on revenues and obviously beating on earnings too. Specialty retail, this is high-end stuff. This is rich people stuff, doing very well. Personal products, doing very well. Multi-line retail, that's like, you know, Sears and stuff. I mean, the large stores. You know, distributors doing well. Food staples, foods are doing well. It's interesting also. Profit-wise, durables are doing really well, which is going to get killed because of the tariffs. Internet catalogs. The earnings are great because that's the thing. The earnings look better than the other because everybody's earnings are affected by the tax rates. But this is a nice, strong report. I mean, on the whole, these are good numbers. So it's not too bearish, and it's a sector. You know, the retail sector has been beaten down, so you have a whole sector of the S&P that can really like bring it up. I don't know what these surprise factors mean, so there's no point in looking at it if we don't know what it means. Anyway, so I found that pretty interesting. It's just a matter of saying that we are having a pretty good earnings season in retail. And we know, especially obviously, anything that has to do with rich people is going to do much better. But this is solid all the way across, and especially because you're driving the bottom line earnings are really being driven in there. And that's coming from the tax cuts. Now, next year is going to be next year going to be total disaster, because when we have to compare, these are the comps you got to compare to next year. It's going to be rough. So keep that in mind. So on the whole, I just don't see that we have, even that's bullish, but I don't see that we have a really good catalyst to be at all-time highs. And again, tomorrow, with China, we may have a trade war part 2. We're going to if we walk away without an agreement. If, by the way, God forbid the NAFTA thing falls apart with Mexico, that would be incredibly bad. But Trump needs a win really badly, and he can sneak Mexico in, even though it's kind of ridiculous considering how much he complained about Mexico, that he's going to suddenly make a trade deal with Mexico that doesn't have anything to do with border walls or anything like that. But he's got to, because he can't, he's got to have a win. He needs something. And he can't control China, but he can control Mexico. He can get a win out of Mexico. But China, if they decide to play hardball with him and he's in a weak position and they know it, they could walk away tomorrow and his thing is going to be in chaos and the markets are going to tank and everything else. So you got to have hedges in place. You got to have something there protecting you. You've got to have cash on the sidelines to deal with things. And again, use these lines in the futures. So you say, at any given time, you say, well, okay, that sounds bad. So if this breaks, like if 60 breaks, we shorted 60. I said before, 30 breaks, we shorted 30. I missed it, but like that. Here you go, if 20 breaks, we can short the 20 line. If 750 breaks already broke, you can short that line. You just got to watch the next breaks and say, okay, as long as everybody's going below, if you see 2 indexes go below, when your index goes below, you say that's confirming it. So right now, really the NASDAQ is lagging. You can see that it's right up its red line. Nobody else is. So the NASDAQ is lagging. They've got the furthest to fall right now. So if any of these guys loses their levels, like if he loses 60, if he loses 20, if he loses 700, which is way over here, well, I'd say he's already lost 750, call that. So let's say the Dow was the first to cross at 750. Now you wait to see if you're getting any confirmation. If you get confirmation, then you short. And you short until the confirmation goes away or until you make some nice money and you put a stop on it. Now, when do you stop? Well, obviously you're going to stop if you see people bouncing back. If the other indexes start bouncing back, even if yours isn't bouncing back, you still get out and stop. And you don't have to be crazy. You can, because you can lose a little bit of money here and get back in here and get back in here, lose a little bit here and here and here. But when you catch one that's right and it goes from 7,400 to 7,350, that's $2,000 a contract. So take a $50 loss, take a $100 loss and live to play again, because if you get one good one, it's going to make up for them all. But not if you refuse to take a loss, not if you don't, not if you don't get the hell out when it's not going your way. That's really the key to this thing. All right, so I don't see anything particularly exciting to trade here, other than, of course, coffee at 100, but we're playing the KCN9. That's next year, July. And it's at 109, basically. So that's one we're playing. But it's not a short-term management. This was just talking about that also. Our coffee trade is based on the fact, and that's BJO is also coffee. Our coffee trade is based on the fact that, clearly we're having crazy weather. Tornadoes, we have hurricanes, we got things going on, we got drought here, flood there. The weather's a little unstable. Coffee is a very sensitive crop, so it doesn't take, whether it's too much rain or too little rain, or whether it's too much heat and it allows a little, there's a rust virus that gets attached to coffee and it stops the cold weather. But if the weather doesn't get cold in the winter, then there's more of the virus to spread and it ruins more crops and so on and so forth. So for whatever reason, coffee is very sensitive, and as the climate shifts, it can cause damage. And if you damage a lot of crops, then you run out of supply and then the price goes up. So I'm just saying that over the course of next year, it's pretty likely that some weather event is going to affect the coffee crops. and cause a spike in prices. And that's all we're playing for. That's the premise. The premise is it's kind of cheap right now. It's very low in its overall channel. And we think it's going to go up from here. We think that also, I think that at this point, at this price, which is 20% below last year's price, or 20% below earlier this year's price for that matter, you got coffee farms that can't afford to keep going. And that takes supply offline. But it takes a while for that to happen. I mean, the first thing you do if you're a coffee farm, you're in trouble, is you try to sell more coffee, right? And what else do you do? That's your thing. You sell coffee. So if you need money, what do? You sell coffee. So they'll push more on the market. They'll accept lower prices, whatever. You know, a lot of that may be happening right now. But then the production starts slowing down and stopping, and all of a sudden you have less crops, and then you have a longer term problem and a real shortage of coffee on your hands, not just a weather incident coffee shortage. But that also takes time for that kind of stuff to happen. So we're taking a long-term position on coffee into next year. And I just really like that trade. I think it's very sensible. And of course, obviously, if the dollar goes down, that supports it. But the dollar's been pretty much on the way up most of the time, so it's hard to be steady on it. But you just have to have patience. That's all. It's a patience play, and it may go down. It's very expensive when it goes against you. It's a very expensive contract, so be very careful. But on the whole, I think that there'll be a time when it'll be all worth it. But that time is certainly not this week. Anyway, all right. See, things are popping up. That's why I didn't want to short, because if it doesn't look great, don't short. Don't if it doesn't or go long or whatever your proclivity is. Don't do it unless you really think you're sure. I wasn't sure. I didn't play. So I end my day with my two little trades. So 270 is 330. I'm done. That's fine. I can make 3 trades. I'd rather make more. I can't live on 330 a day. I need more money than that, but at least it's better than losing money. So, there wasn't a great setup. We didn't take it. And that's the way to play it. You got to learn not to play. If you want to get better at playing, learn not to play. Same thing baseball players say, right? You want to be a better hitter, you got to learn not to swing at pitches. That's the first thing you have to learn if you want to be a better baseball player, is learn what not to swing at. Every pitch is not the one you want to try for. And that's the same thing with investing. You got to learn when to pick your spots. All right, so 3 o'clock, I'm going to cut this thing out. One last question, if there is any. If you're gasoline short, is there an options play for those of us who don't play the futures? Yes, we'll talk about, JC, if you're on the chat room, we'll talk about that. You can ask me in chat and we can go over it. It's UGA is the ETF there. And if not, then next week at the webinar, just remind me and we'll go over it, okay? Because we'll do it again next Wednesday. Next Wednesday is going to be very cool because we're going to totally be playing this oil thing. It's all about the oil next week, so we're going to see how that goes. All right, thanks, guys. Have a good week.